Hey everyone, welcome back to Corporate Decoder, where we break down the confusing language of corporate filings. Today we're diving into Capital One's latest report, and let's just say that when it comes to executive pay and severance, they're not playing around. We're talking about millions of dollars in bonuses and awards. And some pretty interesting new policies around what happens when executives leave. This filing lays out how they're structuring compensation for their top brass and what those executives can expect if things go south. It is a fascinating look into the financial world of one of the biggest banks out there before we get into the nitty-gritty. If you're all about getting to the heart of these financial documents without the corporate jargon, make sure you're subscribed. And hey, we have a growing community on Discord dissecting these filings. The link is in the description below. This filing, dated the 3rd of February 2026, gives us an inside look at some key decisions made at Capital One Financial Corporation. At its core, it is about executive compensation and severance packages. Think of it as the company laying out the rules and rewards for its top leaders. It's not just about salaries anymore. It's increasingly tied to performance, with a lot of the compensation being at risk, meaning they might not get it if the company doesn't perform well. We're not going to get bogged down in the very technical procedural stuff here, but it is important to know that this document is officially reporting specific events to the Securities and Exchange Commission, or SEC. This includes things like executive appointments, departures, and significant compensation decisions, which is exactly what we're focusing on today. Now, Capital One is a big player and they have a lot of different types of securities out there. This table shows us what is registered on major exchanges like the New York Stock Exchange. We see their common stock, which is like owning a small piece of the company itself, traded under the ticker CORP. Then there are various preferred stocks, which are like a special kind of stock, usually offering a fixed dividend. These are known by tickers like COFPRE for Series I and so on. They also have senior notes, which is basically debt the company has taken on, like the 1.650% senior notes due in 2029 with the ticker COF29. Knowing this gives us context for the financial instruments that the executive compensation plans are often tied to. Okay, let's get to the really juicy stuff, the compensation plans. On the 3rd of February 2026, the folks in charge, specifically the Compensation Committee and the independent members of the Board of Directors, approved the compensation for 2026 for Mr. Richard D. Fairbank, who is the Chairman and Chief Executive Officer, or CEO, and also for the company's other top executives known as the Named Executive Officers. Looking back at 2025, Mr. Fairbank had a compensation plan that included an initial award of restricted stock units, or RSUS, and then the possibility of a year-end bonus, which was decided in early 2026 based on how the company performed in 2025. This year-end bonus could be in the form of performance shares, or even some deferred cash, or a mix of both. Everything for these executives is essentially at risk, meaning their pay is directly tied to the company's success. After evaluating their 2025 performance, they approved a total pay package of $40 million for Mr. Fairbank. This $40 million breaks down into a few parts. First, there was an RSU award, valued at $2.5 million, which was given at the start of the performance year back in February 2025. Then, the bulk of it, a $37.5 million year, end incentive award. This incentive award splits into three main components. The first part of that year-end award is approximately $24.8 million in CEO performance shares. These are not guaranteed. Mr. Fairbank could receive anywhere from 0 to 150% of a target number of shares, specifically 111,043 shares, based on how the company performs over a 3-year period, from the start of 2026 to the end of 2028. A large chunk of these, about $22.1 million, will vest based on financial performance metrics like growth of shareholder value and adjusted return on tangible common equity, or access another portion. Around $2.7 million is tied entirely to how Capital One's stock performs compared to its competitors, which they call total shareholder return, or TSR. The idea here is to reward long-term company success and make sure the executives are focused on shareholder value. The peers for comparison are companies in the KBW Bank Sector Index, excluding those that are solely custody banks. Second, there is a deferred cash bonus of $6.7 million. This isn't paid out immediately. It is mandatorily held for 3 years and will be paid out in early 2029. This is a way to keep executives invested in the company's long-term future. The third part of the year-end incentive is a grant of 26,865 RSUS, valued at $6.0 million on the day they were granted. These RSUS will fully vest on the 15th of February 2029 and will settle in cash. The cash amount will depend on the company's average stock price in the 15 trading days leading up to that vesting date. Importantly, these RSUs also have performance-based vesting requirements, similar to those given out earlier in 2025 to Mr. Fairbank. Now, looking ahead to 2026, the plan for Mr. Fairbank is also structured to be heavily performance-based and deferred. The compensation will consist of an equity award in the form of restricted stock units, or RSUs, and the chance to earn a year-end bonus in early 2027. Again, based on Capital One's performance in 2026. Just like 2025, these awards are entirely at risk and have a 3-year deferral period. Notably, Mr. Fairbank's 2026 compensation plan does not include a cash salary. Specifically, on the 3rd of February 2026, Mr. Fairbank was granted 11,194 RSUs with a value of $2.5 million at the time of grant. These RSUs will fully vest on the 15th of February 2029 and will be paid out in cash based on the average stock price over the 15 trading days before they vest. He also has the opportunity to get a year-end incentive award in early 2027. This bonus will depend on Capital One's performance in 2026 and Mr. Fairbank's individual contributions. The Compensation Committee and independent directors have complete discretion over whether to give this bonus, what form it will take, and how much it will be. Any award will be performance-based over a 3-year period from the 1st of January 2027 through the 31st of December 2029 and can include performance shares, deferred cash, or both. Again, it is all at risk and performance dependent. It's not just the CEO who gets these kinds of awards. On the 3rd of February 2026, the other named executive officers also received awards for their performance in 2025. These awards included cash incentives, stock, settled RSUs, and performance shares. The terms and conditions are pretty much the same as what was described for Mr. Fairbank and previously detailed in their 2025 proxy statement, focusing on both company and individual performance. For 2026, the plan for these other named executive officers is also being shaped. Their total target compensation for 2026 will range from $6.0 million to about $8.0 million. This compensation will be made up of 3 parts. About 20% of their total target pay will be a regular cash salary, paid throughout the year. This is the fixed part of their compensation. Another 25% will be an opportunity to earn a cash incentive award in early 2027. The amount of this bonus will be entirely at the discretion of the Compensation Committee and independent directors based on Capital One's 2026 performance. The final roughly 55% will be in the form of equity awards. This includes restricted stock units that settle as actual company shares and performance share awards. Similar to the COS, these performance shares could pay out from 0 to 150% of a target number of shares based on the company's performance over a 3-year period from 2027 to 29. These equity awards will be granted in early 2027, and their payout is also discretionary and at risk based on 2026 performance. Moving on to severance, an important topic for executives. On the 3rd of February 2026, a new executive officer cash severance policy was adopted, effective the 1st of March 2026. This policy puts a cap on how much cash severance can be paid out without getting shareholder approval. For any new employment or severance agreements, or any new severance plans, the cash severance benefits cannot exceed 2.99 times the sum of the executive's base salary plus their target bonus. This is a way to avoid excessively large payouts that might not be viewed favorably by shareholders. Then there is the Executive Change of Control Severance Plan, or COC plan, also effective the 1st of March 2026. This plan is designed to protect eligible employees, including all of Capital One's named executive officers, in the event of a change of control, which typically means a merger or acquisition. If an eligible employee is terminated without cause, or resigns for good reason during a specific period around a change of control, they can receive severance benefits. For the CEO, the severance includes a cash payment of 2.5 times their base salary plus target bonus. For other named executive officers, it is 2 times their base salary plus target bonus. On top of that, they'll get any earned but unpaid bonuses, a prorated bonus for a partial performance period, and cash to cover Cobra Health benefits for 2 years. This plan supersedes previous agreements, ensuring a standardized approach to severance during a change of control. Finally, there is the amended and restated Executive Severance Plan, also effective the 1st of March 2026. This plan covers eligible associates, meaning the named executive officers other than the CEO, who are involuntarily terminated due to restructuring or poor performance. Under this updated plan, these executives will receive a lump sum cash payment equal to their annual base salary plus their target annual bonus if they face an involuntary termination. This is subject to them signing a release of claims against the company. The other parts of the severance, like outplacement services and subsidized health benefits, remain largely the same as the original plan. To wrap up our look at the document itself, this section is basically a table of contents for all the supporting documents that are attached to this filing. Here we see references to the actual text of the policies we just discussed, like the cash severance policy and the CORP plan, filed as exhibits. This is where legal teams and interested parties can find the full exact wording of these agreements. And finally, the signature indicates that the document has been officially approved and submitted. This is signed by Matthew W. Cooper, who serves as General Counsel and Corporate Secretary for Capital One Financial Corporation, confirming that the company is formally presenting this information to the CC now. Let's look at this from a broader perspective. What does all this tell us about Capital One? We see a clear strategy of tying executive compensation directly to company performance and long-term shareholder value. The millions in performance shares and deferred compensation signal a commitment to keeping executives focused on sustained success rather than short-term gains. The substantial severance packages, especially in the event of a change of control, are designed to reassure top talent during uncertain times and to ensure a smooth transition, or at least a significantly compensated one for executives if the company is acquired or merges. However, we also have to consider the risks, while performance. Base pay can be a powerful motivator if the company's performance metrics are too complex or don't truly reflect sustainable value. It could lead to unintended consequences. The hefty severance packages, while standard in large corporations, do represent a significant potential cost to the company, especially if multiple executives trigger these clauses simultaneously. In my opinion, Capital One is playing a high-stakes game of executive compensation and retention. They are using significant financial incentives and robust severance packages to attract and keep top talent, which is crucial in the competitive financial services industry. The focus on performance metrics like growth of shareholder value and adjusted return on tangible common equity suggests they are trying to align executive interests with those of shareholders. However, the sheer scale of these compensation and severance packages raises questions about the balance between rewarding leadership and managing shareholder capital efficiently. It's a careful balancing act, and the long-term success of this strategy will depend on Capital One's ability to consistently deliver strong financial results and navigate the evolving economic landscape. Alright, that is our deep dive into Capital One's executive compensation and severance plans. What is your take on these arrangements? Do you think they strike the right balance? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button. It really helps us out. And don't forget to subscribe for more corporate insights. Also, check out our Discord community in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next video.